Jonathan, given the increasing amount of money that's been raised in PE, that means a lot more money is chasing limited opportunities. Sure. What has General Atlantic been doing to differentiate itself and give itself an edge?
Yeah, well, I think some are structural, and the other is probably philosophical. The first is from a philosophical point of view. We've always been singularly focused on partnering with growth companies and understanding their challenges and helping them minimize the execution risk that comes from that growth. So I think there's pattern recognition that we're able to observe and hopefully learn from the cumulative sets of mistakes that we've observed over the years. From a structural point of view, we have a single pool of capital that unites everything we do globally. And so that allows us to dynamically load balance our resources and our capital to find the best opportunities wherever they might reside. And the majority of what we do are actually minority ownership positions. So there's a positive asymmetric bias towards getting those companies that probably don't need the capital, but are looking for a partner as distinct from an owner. And when you underpin that by having a dedicated focus to certain sectors as opposed to being a generalist, it allows us to add that value.
You mentioned your single pool of capital. How do you allocate that between domestic and international opportunities and across sectors?
Yeah, well, today about half of our people are outside the United States in 12 offices. Roughly half of our investments are outside the United States as well. We have a central investment committee, and the responsibility of that committee is to find the best opportunities. And we invest roughly $2.5 billion a year in somewhere between 10 and 15 companies, again, regardless of sector or geography. It ends up being allocated across our 5 sectors, which are financial services, healthcare, internet and technology, business services, and retail and consumer. And so kind of best idea wins, as opposed to having the pressure to deploy capital potentially in an unnatural time in a cycle, because that's where your fund's mandate or regional mandate requires that you invest it.
Okay. 2 big surprises this year have been Brexit, the UK's vote to exit the EU, yeah, and the US election. How does that affect investment opportunities?
Yeah, well, I think in general, uncertainty is bad for the markets. For better or for worse, I think there's at least more stability right now. I think you're seeing an incredibly positive response in the stock market here in the US. In some ways, maybe even ahead of itself. I don't know if we've seen enough details out of the Trump administration as to what that portends. I think there's a general perspective that there's probably more growth-oriented. Some is probably emotional. I think there are a lot of people who felt disenfranchised from the previous administration that now feel that they have their axe in office. And I think you're seeing from those professional money managers that you probably have a much more benign Donald Trump than perhaps one might have seen along the election campaign. And so I think you're going to see generally a bias towards stimulus, lower tax rates, which will improve corporate earnings. And so far, jury's out, but he seems to be surrounding himself with some good people as well. So I think that all portends for some pretty good things perhaps to come. I think one area where we could have it destabilize is if, for example, we start pulling out of certain treaties, whether it's a TPP or NAFTA or NATO or others. I'm not sure that's a risk that today is being priced into the market.
Speaking globally, developing economies like China, India, Brazil, Mexico have all been create a lot of anticipation about them as being investment opportunities. How do these countries differ?
Yeah. Well, they're all important to us. I mean, we have investments in all of them, fortunately. I think each one's got some specific opportunities and challenges ahead of it. For Mexico, for example, all too often that's broadly cast into broader Latin America, when in fact its economic fate is inextricably tied to what's happening in North America. And so in some ways, there's an arbitrage around Mexico where there might be a Latin American discount that might be incorrectly applied to it right now. Brazil, no doubt, is way out of favor. We tend to take the opposite view on that. We think it's a wonderful time to be deploying capital in Brazil. You've got a well-educated workforce. You have a couple 100 million people, so you have deep domestic markets. You've had some important changes in the government as they try to root out corruption. So those all are natural biases for great tailwinds. India, we've made a significant number of investments in the recent past or will continue to do so. In India, we're seeing great stability. You're seeing interest rates stabilize. You have a new prime minister, which has added a much more pro-business mindset. So we're very excited about the prospects there. And then China has always been a critical part of our strategy. Huge domestic market, unbelievable secular tailwinds that we're seeing there. So we're trying to put capital to work across the broader spectrum in China as well.
Your personal focus is financial services.
That's right.
Are there certain verticals within financial services that you like or don't like right now?
Yeah, well, financial services today within GA is our largest portion of the overall portfolio, and it's probably among our most diversified with regard to subsector as well as by region. And so for us, I think we have to look at it through different lenses. Domestically, I think one of the better opportunities is to try to fill some of the voids of the unintended consequences of regulation. where some of the traditional institutions are no longer economically able or interested in serving huge swaths of the population. So we've certainly tried to put a lot of resource against that. In some of the emerging markets, I think the opportunity set is to equip the system with its core financial infrastructure, whether it's on payment infrastructure, as you play a secular trend from offline cash payments to more electronification. I think that's a great opportunity. Domestic wealth management in many of these markets is great as GDP grows. People will need to find ways to productively deploy that capital. And then broader financial inclusion. Banking, micropayments, and other non-bank finance is a great opportunity in many of the emerging markets. And in Europe, I think you're seeing a disproportionate set of opportunities as banks are struggling to comply with some of the capital requirements imposed on them by Basel rules. And that's allowing us to set up a much more constructive partnership with some of these banks, including most recently, we helped carve out Santander Asset Management from the Bank Santander by setting up a JV with them. And I think you're going to see a lot more of those opportunities, and we're certainly trying to position ourselves for them.
Okay. FinTech is presenting some challenge to established institutions. How do you see that dynamic playing out?
Yeah, I think, hopefully in 10 years' time, we're not even talking about FinTech as a separate sector. I think every aspect of the financial services landscape is going to have some real technology enablement. I think over the last 24 months, you've seen a pronounced move towards the middle where you no longer have the bravado of FinTech companies saying they're going to displace the banks, and you don't have the banks necessarily have some of the hubris to say they could squash all the FinTech companies. And I think what we're starting to find are true partnerships between the two. And so my guess is you're going to see a lot more hybrid offerings. But there's also no doubt going to be a shakeout. There's been a lot of capital deployed against FinTech, and many of these are Me Too companies. And I think the market's beginning to discern those businesses that are truly differentiated and innovative, and others that are just also rans.
Okay. Jonathan, thanks for your time.
Thanks so much. Appreciate it.